Joining us, Stephen Bigar of Argus Capital and Christopher Walen of Walen Global Advisors. Very good evening to you both. Thanks for joining me. Stephen, my first question is whether or not next year will be a year for the retail banks, for those that are geared to the yield curve, or the capital markets banks once again.
Yeah, good evening, Wilfred. I think the pendulum might swing more to the regional banks this year. You know, we had a really perfect storm in both 2020 and 2021 for the capital market sensitive banks. Just a terrific year for IPO issuance, equity issuance in general, a record year, trillion plus, good M&A activity. Looking forward, I think the interest rate sensitive banks here, the lending businesses, looks like we're going to get 3 interest rate increases this year, next year. That's helpful for net interest margins. We've got a continued great credit quality environment, so that bodes well for the regional banks.
Chris, do you agree on that? Or, I mean, I've heard you recently be a little less constructive on what those yield curve sensitive banks will be able to do next year.
But it's always tough to convince people of this, Wilfred, but you got to focus on spreads rather than benchmarks. The spreads for lenders, for example, have been very tight. So this year we may see improvement. That's what we're hoping. We had 2 very difficult years where the capital market side carried the day, really. It was like the defense coming to the rescue of a weak team in the NFL. But now we're hoping, like we say, a couple rate hikes. Maybe we see spread expansion in consumer and mortgage, maybe also in C&I. But the one question I have that I think everybody's got to take to heart is that multifamily real estate, rental properties are in big trouble. That's the one area of real estate for banks right now that's 100% loss on default. Everything else is negative, by the way. You can't lose money on a 1 to 4 family loan, but you can lose a lot of money on a mortgage on a large piece of property that was heretofore gold, that only went up in value. So I think commercial properties in urban areas and multifamily rental properties are going to be a tough place for banks, especially community banks, because this is their asset class. You know, think about New York City, Wilfred. They love that asset class. It's gone up for 50 years, and now it's under a cloud. So that's the only, negative. I think overall this is going to be a better year on fundamentals, but it may not be a better year on stocks for financials. That's the irony.
So, Stephen, one other big question has been regulation. In fact, today, rumors that Sarah Bloom Raskin might get Randy Quarles' seat on the Fed. Of course, that far from confirmed. Do you really think we'll see the pendulum swing back considerably to heavy regulation, or is this just sort of political talk, and once the appointees are appointed, it'll just be changes at the margin?
Oh, I do think that this will be the year for the pendulum to swing back. Frankly, I'm surprised it hasn't happened already in the first year of the Biden administration. But there's certainly been a lot of talk both at the Fed and the SEC level about regulation, about climate change. They always want to kind of tinker around with lending practices, things like that. Supplementary leverage ratios, always more capital. Do the bidding of some of the politics. And so I think that could be disruptive. It could be disruptive on the business model. It could be disruptive in terms of costs to comply. There's no real upside necessarily on the revenue picture from that. So I think we'll see. And where that could kind of bite is in buybacks, which have also been talked about as overly generous by politicians and regulators alike, and we could see that at the next round of the CCAR results. So I don't, as much as the bank earnings have been extremely strong, I think they may be a little bit more cautious on the buyback and dividend increase plans when we hit CCAR results mid-year.